I think over 100, probably close to 100 participants online. So let's get this kicked off. And so my name is Greg, and I'm the marketing director here at CoPower, and I do not have a financial background. And so I have very good questions here to these very fine experts who will help us and help me as I am currently going through the same process as many of you, trying to figure out what to do with my RSP TFSA, because I want to do something and I honestly just don't know what to do. And so that is why I'm going to hopefully help moderate this conversation. And so first off, let's introduce these speakers. And so first, on my far left, we have Tom Rand. So Tom is the managing partner of ArcTurn Ventures, a privately backed early stage fund focused on delivering next generation clean technology at scale. In addition to investing in clean energy, Tom sits on the board of a number of clean energy companies and environmental organizations. Not to mention is the award-winning author of Kick the Fossil Fuel Habit and Waking the Frog, Solutions for Our Climate Paralysis. Welcome, Tom. And then we have Jennifer McDonald. Jennifer is the manager of impact investing here at CoPower. And CoPower is a clean energy investment company that allows Canadians to participate in and profit from the transition to a clean energy future, currently through their Green Bond retail investment product. Previously to CoPower, Jennifer worked to integrate ESG and clean energy investing in various roles at RBC Global Asset Management and BMO Capital Markets. And that's Jennifer. And then further to my left, we have Tim Nash. And Tim is the founder of Good Investing. Good Investing teaches people how to invest online and make intentional decisions about what they're investing in. Through its fee-only financial planning services, Good Investing's clients learn the basics of investing and how to earn good financial returns while supporting what they care about. Tim has become a bit of a media mogul, my words, not his. I wrote that in, becoming a go-to expert on sustainable investing, from BNN's Market Call to the Star, Globe, Money Sense, Routers, you name it. He's become a 10-year advocate for the space, and I can't wait to hear more from Tim tonight. And then last night we have Heywan Kong, and Heywan manages AGF's Sustainable Growth Equity Strategy, wholly focused on investing in solutions to sustainability challenges to create positive impact. That's a cool sentence. Heywan sits on the ESG committee and provides strategic advice to implement responsible investing in AGF investments. Heywan is also a member of several investment advisory committees, a frequent guest lecturer on the topic of sustainable investing, and a co-founder and chair of the Toronto Responsible Investing Working Group. Thank you all for being here. A real quick round of applause for our four panelists. I haven't done anything yet, but we look good. Yes. And so, super brief agenda. We're going to talk about the why, the what, and the how of the topic of adapting your investment portfolio to climate change. And so, going to start it off, Tim. Why should investors care about climate change? The highest question.
Sure. Do you like your money?
I do.
Do you want to have more money in the future?
I do.
So you should invest in things that we need more of. And that the issues that climate change, like the internet that came before it, is really going to change every single sector of the economy. So understanding that this is a system-wide risk, but also an opportunity. And right now, Canadians, just by default, because we're all investors in the Canadian pension plan, whether you like it or not, and that oftentimes the default setting for people who do invest here in Canada is to invest a lot of their money in the Canadian stock market. And the Canadian stock market has a lot of exposure to fossil fuels and a lot of exposure to what I would call carbon risk. And so if you understand, if we're looking at this and we accept that, climate change is real and the science is settled and that we really need to start moving in this direction, then really it just makes financial sense to be able to start moving your money and kind of get ahead of that curve. Beyond from there is obviously the ethical implication as well, that if you care about climate change and you're advocating and you're doing things in your daily life to be able to lessen your impact, this is a fantastic way to be able to lower your carbon footprint.
And so in the financial industry right now, we're starting to use or seeing terms like climate risk and carbon bubble. Can you do a quick definition, Tim, on what, for the audience here, generally, sure. Climate risk, carbon bubble?
I'll start with carbon bubble, and then I think that'll explain the risk. The carbon bubble is this idea that all these companies, so I can think of dozens of companies that operate in the oil sector, and if they've got reserves, so we can talk about Suncor. Suncor has fossil fuel reserves. So they own land, and under that land there is, there's oil sands or tar sands, depending on what side of the spectrum you're on. Really, this is an asset that counts on their balance sheet. So that's money. And their business plan, very simply, is to dig up those fossil fuels, to process them, sell them, and then with the assumption that someone's going to burn them. Obviously, that has huge implications when it comes to climate change. So based on the math that a lot of great organizations like 350.org have put forward, what they say is that out of the proven oil reserves, so these are the assets that we already know exist that are currently sitting on the balance sheets of companies, that about 80% of them need to stay underground if we're going to meet our climate change goals. That if these businesses execute their business plan, that we're going to start to see runaway climate change if we're not already. So what the carbon bubble suggests is that as we start to realize that, oh my goodness, this is sort of this existential threat that it actually is, and as governments start to implement policies, we're in a situation where a lot of those proven reserves could get written off, where these companies basically have to make the strategic decision that those are no longer assets that we're going to be extracting. In that scenario, that's when the bubble pops. Because now whatever I forget the exact number, but it's in the trillions, the value of those assets. Just like in 2008, we saw the toxic assets where, all those real estate assets, it turned out they weren't worth very much. All of the assets that they have today aren't going to be worth nearly as much in that future.
So they call it stranded asset because those assets are actually, it's a stranded. It's not, you cannot get that asset. You cannot get the value out of those assets. So that's why now even there's terminology for that reserve. We call it stranded assets. And a lot of investors looking at the companies with more stranded assets, that is bad investment. And another thing about climate risk, I just wanted to add to Tim is actually we've just seen the first example of climate bankruptcy. So we saw how PG&E in California is a utility company. We saw all these wildfires. How did it affect even the utility companies? Because all these falling trees, they affect the power lines. I mean, we have that issue here in Toronto. So all these companies can actually contributing to more climate change, but at the same time, it can be the victim of climate change. And it's not in 10 years or 20 years. We are actually witnessing it right now.
So I think this is a good opportunity to get all your thoughts. So on that concept, what are examples of how these types of risks are going to be felt in the Canadian market? What are even industries or things that you are seeing or projecting that are coming up that are going to be hit hard or hit? Any thoughts?
Well, I would argue, so I have a view where I invest in clean tech. I invest in technologies that compete with fossil fuels head to head in the market and are beginning to win head-to-head in an open market. So objects in mirror are closer than they appear. We see that's what's happening for oil. People discount, I see so many oil executives who point to rising demand and say, look, I'm just meeting rising demand. There's nothing I can really do. Which first of all, I think is disingenuous because I think of all the people that could bend that curve downward, it would be the industrial giants that are oil majors. But I think what they're discounting is how fast technology comes into play. And it's true that electric cars are not like an app. They don't just multiply without friction. But if you look at things like the double derivative, like where if you in China, for example, car sales flattened, but EVs rose last year. That's an indicator that EVs are beginning to grab market share. And you don't see an exponential curve becoming exponential until it's too late, right? It looks linear for a long time. That's what's happening on electrical production to compete with natural gas and coal. Solar plus storage is happening with EVs. So the risk, I think, to those who sit on these assets, they assume that demand will be there tomorrow. Canadian producers in the oil sands assume there will be demand for the stuff that we're putting in pipelines. I don't think there will be. Canada should be very aware that we are selling the highest carbon, highest cost oil on the planet. And that's a marginal reserve. As the world gets off oil, it is not the Saudis who will turn their taps off. It will be Canadian heavy bitumen that will be the first that will lose market share. And that will make Edmonton a ghost town. That will devastate our RRSPs. So, you know, I hate to say it, but the success of clean tech, which is what I invest in, implies the demise of things like heavy oil. And I think that's what Canadian investors should be really aware of. That's happening faster than people think, and certainly faster than Canadian oil executives are acknowledging.
So let's keep on the opportunity or even sector opportunities. You just mentioned a lot about clean tech and clean energy. What are other opportunities, other sectors that you see to benefit from what's happening?
I mean, it can come from so many different sectors because this is exactly what I'm looking at every single day. It can come from any traditional sector, you know, even consumer sector or material sector, industrials. There are so many companies that can provide, you know, any solution to reducing the carbon intensity or enhancing energy efficiency. So in a transport sector, you can have the companies that are providing the right sensors, even the components that can help. You can monitor your trucks or your speed better so that you can improve your fuel efficiency, energy efficiency. It can come from, you know, even now, you know, all the focuses are only blaming sometimes oil and gas sector. But we have to also think about the whole value chain. So there are those producing oil and gas, fossil fuel, and also we are, you know, as a consumers, we are relying on it. So if you think about, again, so many plastics, single-use plastics that we are using, if we can move away from plastics, that's, again, consuming less of the fossil fuel. So, again, some of the companies that are providing more natural ingredients, that rather than using the fossil fuel-based chemicals. So the opportunities, climate opportunities can come from so many different sectors and industry. It's not just about, you know, investing in only one renewable energy, but the whole cleaner clean opportunities are just everywhere, because I'm just seeing so many companies that in our universe, investable universe, we can look at, you know, there are more than 1,000 companies that I can look at that point out this company provides solutions to climate change or environmental pollutions. There are so many issues that these companies are addressing.
Nice. Yeah.
Yeah. And I mean, obviously, I don't have the crystal ball, so I don't know exactly which sectors are sort of going to do the best going in the future. But looking at, I would say, over the last 6 months, which has been a really interesting sort of roller coaster in the markets, where, you know, sort of in September, October, things started to go down. December was a horrible month. It kind of bottomed out on Christmas Day and then has since sort of bounced back. And the two sectors, green sectors anyway, that I've seen that have done well in my portfolio are water. Water has remained fairly resilient, and certainly I see some huge implications with climate change when it comes to water utilities and the companies that make all the hardware, and also environmental services, which is sort of cleaning up pollution. And a lot of the companies that, you know, it's one of these things where in a perfectly sustainable society, there would be no pollution, right? Like there wouldn't be money made to be made doing that. But right now, where, you know, in the world that we exist in, there's a lot of pollution. There's a lot of waste, and that needs to be cleaned up responsibly. And those two sectors have really proven to be really quite resilient when it comes to my investments.
And now, Heywan, you mentioned about the PG&E risk and the climate situation that happened there. Are there any other surprising examples like that you guys can share to articulate that this is happening? And PG&E, I think, is a great example. Are there others?
Sure. There's E.ON in Europe. They've spun out their nuclear and coal business with the intention that it will spin itself down. In other words, as it's become like a REIT, where all it will do is spin out profits until the end of the life of those assets. And E.ON has the other half of their business. They're trying to figure out how, as a utility, they will be an energy services company. How is it that they interact with big emerging sector, grid scale energy storage? How will they play on energy efficiency? How will they go behind the meter to help their clients? So that utility that is taking a very forward-looking view of their role in the future, we still need wires, we still need utilities, but we don't need coal plants and giant, you know, spoken wheel type of utility architecture. And that's kind of signaling where utilities are going. If you look in places like Arizona, You have Solar City putting up so many panels on so many rooftops that last year the governor and the local utilities sued to stop Solar City from putting up more solar panels, which is interesting, right? You know you have the incumbent's attention when you're getting sued by the governor and the utility. I think it's a great sign. But utilities are seeing their business models being highly disrupted by microgrid technologies behind the meter, which can produce energy cheaper than the grids can make it. I'll give you another quick example. You now have projects in Australia. One of our companies, Hydrostore, is bidding on a project with a mining company where it will be grid scale energy storage. So it's compressed air energy storage, giant storage stuff, batteries made out of water, rock, and air, combined with a large solar field where they will bid on 24-hour-a-day base load power. So it's solar plus storage, nothing else, that is cheaper for that mine to contract than what they can get from the grid. That is an incumbent who has already got assets paid for, throwing power onto the grid, and they can't do it cheaply as upstarts who are coming in there with solar plus storage. That is highly disruptive. Once the financial community begins to provide debt capital to the likes of those developers, where they can get access to 6% financing like the coal guys can, that is an unstoppable change to utilities, both the producers of power on those utilities and those who run the big wires. And I think that will be as disruptive to that sector as EVs are to heavy oil.
Right.
You also have GE and Siemens. So 30 years ago, GE was the largest company in the S&P 500. And about 15 years ago, they bought the natural gas turbine assets from Alstom, thinking that natural gas was going to be the way to go. And what they've seen is that as renewable energies have come down in price, the cost per turbine for natural gas isn't as competitive. And they've taken massive write-downs, and they cut their dividend for the first time, I think 18 months ago. And so they're, GE, like, it was the behemoth. No one could ever take down GE. And they're a really good example. Within 18 months, cut the dividend for the first time in 40 years.
And again, how many bankruptcies we have seen in the coal industry. Again, you can maybe Trump can revive the coal industry again, but again, question mark, it's just economically not viable. So many industry thinking, this will last forever, but it doesn't last forever. And also same with even Volkswagen scandal. When you look at how with this more and more stringent fuel efficiency standard, and with the combustion engine, you have higher compliance costs, and it's very difficult to reduce both increase fuel efficiency at the same time, reduce air pollution. So the whole cheating was, if you are not spending a lot of money and capital to R&D to come up with the better solutions. Easy solution was the cheating was not the best solution. But again, we are seeing a lot of these scandals because there are higher costs involved to comply with some of the environmental regulations. And so it's not going away. Even in the US, it's not going away. Even in emerging market, it's not going away. It's just getting more and more stringent. So the companies that can, proactively address, or the companies that are actually benefiting from this transition, that's where your investment should be.
And this is connected to climate risk. So when we're talking about it, and a lot of investors are pushing corporates to file and report on their carbon emissions. So when we talk about climate risk, as an investor, you have to accept a level of risk. So you have your intended risks and you have your unintended risks. So you're probably willing to accept, investing in the TSX, you're comfortable with it, but it's all the unintended exposures that investors need to be aware of. And so if it is carbon, if you do get a price and a tax on carbon, it's companies that you might not even think about. So in the TSX, we're 20% oil and gas production, and that's naturally a very high carbon intensive. But look at the Canadian grocers. You walk into a grocery store and their freezer aisles are all open, their doors are open, they emit more carbon than you probably think. And so, while they're not big, they're 6 to 7% of the TSX. And so it's all of the carbon emissions that you don't think about. Companies do have quite a lot of it. And it's not just one sector, it's all of the sectors.
And so now let's bring it to the individual. So Jen, you talk to investors all day long. And so are you getting those concerns are you getting these types of concerns from individuals that you're talking to? Is that a motivator of them? Like, what are you hearing from them?
Yeah, so last November, we released a thought paper that showed that the average Canadian's investment portfolio has a higher carbon footprint than that of the living, breathing Canadians themselves. And so if your average carbon footprint is 21 tons and your portfolio is emitting something greater than that, it's an area that you want to look at. And so we have investors that, they're 90% invested in equities, and whether that's the TSX or the S&P 500 or MSCI World, they have so much exposure to it, they're looking to take a little bit of money off the table, especially given the volatility in the last 6 months. So clients are asking for something that doesn't look like the index and something that they can feel good about.
Yeah, and I think sometimes you have to also think about beyond carbon, because a lot of focus is on the carbon, but the greenhouse gas emissions is beyond carbon, and also water. You cannot really avoid the water risk or opportunities when you think about climate change. And again, some of the environmental, how you use your land, that also can affect. So there are multiple consideration that you have to do as an investor when you think about the climate. And again, there's a whole consequences and just talked about. There are indirect consequences. Again, so we are looking at, again, carbon footprint, but not just carbon, environmental footprint. So we are looking at different environmental factors in every investment that we are making. And sometimes you get really surprising outcome from this analysis that, this wheat maybe consumption from Southeast Asia can be actually higher, more carbon intensive than oil and gas. Wow, how is it possible? And you're looking at, and sometimes indirect emission as well, not just direct. So it's a little bit more complicated when you go really deep with how you make your investment decision. But I think that has to be, the responsibilities on us as an investor, as a portfolio manager. We have to look at all this negative impacts that my investment can make. But at the same time, I want to maximize the positive impacts. So providing solutions to the sustainability issues so that you can maximize your net positive impact.
Yeah, Tim.
Yeah, so, I'll be honest. I talk to a lot of clients every day, regular people, and nobody comes to me because they're worried about climate risk. People come to me because they're feeling helpless right now, and they're looking for something that they can actually do in their lives that's going to make a difference and that's going to have a positive impact on this very, very scary issue over which we honestly have very little control right now. With governments that are in place, and I think there's a lot of frustration right now, a lot of fear, and I think more than anything, people just want to do something about it, but they don't really know what to do. Fortunately, this message is getting through that one of the biggest things you can do in your life is to look at your investment portfolio. And it's not a silver bullet, so by all means still ride your bike and eat less meat and, travel locally, support your local tourism rather than flying. But that really it's one of these things where I find for me, in terms of making these decisions, a lot of them are really hard, like, in terms of ethical consumerism and going out of my way to sort of buy and live a low carbon lifestyle. It's decisions that I have to make all the time. Whereas when it comes to your investments, this is one thing where, like, quite honestly, the way people approach this is they do it once and then they don't want to ever think about it for a really, really, really long time and just let it do its thing. So, so a lot of I would say the rationale for why people are doing it, it's really not the economics, at least in my experience with my clients. It really is kind of coming from this heart center where they know it's the right thing to do. They know that it's something that they should do and they're excited for the impact. And then when they find out, and I talk to them, that actually the returns are just as good, if not better. And understanding that if we're investing for a long-term horizon, if we're really going to see this economic shift that we're up here talking about, that this really makes a lot of financial sense. I would describe that almost as like the icing on the cake. But most people that come to me, it's really because they just want to feel powerful. They want, we feel so helpless all the time.
And so you've got clients coming to you wanting to move money into what they don't want, into what they do want. How fast are we actually seeing the financial landscape change? Is it actually, are we seeing a meaningful rapid shift of capital? Is that going to happen? Like, is that happening now?
Well, it depends. So as an investor, I am deeply bullish on clean tech. My investors, in our turn, we're more aggressive than that. We're looking for venture type returns. Yep. We're looking to disrupt technology markets. It's high risk, high reward. Get out there, and if you in a market economy, solve a big problem, get a big reward. It's a very aggressive. Make lots of money solving the problem. Don't get a second-rate return by solving that big problem. Get a better return because markets reward solutions to big problems. So as an investor, I'm totally bullish. I mean, solar is $300 billion a year now, so it's the cheapest form of new energy on the planet, et cetera, et cetera. As a human being, I'm deeply pessimistic. We know we need to be deploying this technology about an order of magnitude faster than we are to have a snowball's chance of stopping at 2 degrees. I think 2 degrees is in the rearview mirror, to be honest. I'm sorry, but it is. To stop at 3 degrees, to maintain a reasonably stable global civilization, we need to be deploying this stuff far faster than we are, far faster than the markets will do it, even with a moderate price on carbon, the maximally politically possible price on carbon. So as a human being, I am deeply dissatisfied and pessimistic about whether this technology will solve this problem. At the same time, as an investor, we're going to make tons of money selling clean tech because you cannot stop the economic inevitability of a technology-driven energy source kicking the pants off a resource-driven energy source. So that's great. Then that paradox that any climate-savvy investor has to live with is cognitively problematic. But the math is simple. The market's big, technology's winning. We're going to make a lot of money building hydrosource systems and all the rest of it. But we're not seeing the kind of deployment from Bay Street and Wall Street with a T in front of it yet. And unless there's a T in front of that number, we're not touching this problem. So that's an optimistic yet sobering thought.
But we actually saw T number, so it's interesting. There are a lot more climate aware investors. I think the problem definitely lies whether we can really invest into solutions and opportunities. That's where I still see big opportunities. We need your help to move this capital more towards solutions and climate opportunities rather than just status quo. Yeah. And again, the climate aware investors. So I think we have to do every action possible. So one action is definitely ask. So ask government, ask your pension manager, ask your investment manager, ask companies, ask everyone, because actually this asking, I saw the positive impact of even small move from big oil and gas companies. Now there are a lot of collaboration going on amongst investors. So different financial institutions now working together to actually ask governments. So we are engaging a lot more policymakers to make that change in terms of the more policy towards. And we are asking companies, so the companies deploying their capital more towards green rather than brown. So it's possible, it's taking time, but again, we really need this collaboration and collective actions.
Maybe just in the middle, because on the institutional side, for sure, you do want to see those large pension plans, CPP or OMERS or OP Trust doing something significant, and they are within their own funds. But then also on the retail side, if the Canadian retail market is $3 trillion, it's everyone in this room who does an impact investment, finds a product that actually is good for the portfolio or can offset, and then tell their friends about it. And so even if you captured 10% of that retail market, and retail investors, I think right now are getting frustrated with what the traditional financial institutions are offering them. And so even if the big banks or the large asset managers don't have a product, it doesn't mean that they have to wait. So investors aren't beholden to their advisors anymore. They can look outside of public market securities and look at venture cap funds or look at impact investments and do their own work and then tell people about it and be that 10%, be that 15% that can help deploy faster.
Can I plug CoPower for a second? I'm not an investor in CoPower, so this is not a self-interested plug.
Why not?
But one of the things that, so that I remain a disinterested third party able to speak eloquently of the good work that you do and be taken seriously. What CoPower is doing is rather than just playing defense and avoiding climate risk and avoiding the carbon bubble, moving capital into solutions is the trick. And a lot of people want to do that. And the dearth of retail possibilities, I think, is to the shame of our big banks, honestly. And David Berliner and CoPower went out there and said, look, we're going to build a green bond and we're going to make it available to retail customers. I'm going to make it safe. You invest in projects, not venture. I think it's a good thing. Retail investors should not invest in my fund. High risk is not for the retail investor. But being able to carve out a space that says to the average person who wants to put their money on the table solving the problem, there were no opportunities for that before CoPower came along. And the fact that behind the scenes fairly complex thing, but on the front end, very simple idea, took an entrepreneur to do and deliver to the public, I think is a little odd. And I think its success is a signal to the big banks and big institutions that there is a market there. You're not listening to people. People want to be a part of the solution, and they want to do something more than change a light bulb, and they want to use their money to do it, and they don't want it to be complicated. So that's what CoPower has done. I think what CoPower has done will open up a flood of competition, and hopefully you'll stay out of that competition because you deserve it. But it's a bit strange to me that Canada needed an entrepreneur to figure this out and offer it to the public rather than the big banks figuring that out. And I think that's to their shame, but I hope they're gonna catch up and figure that out. Again, moving money onto offense on climate, not just defense.
And I want to take the opportunity to actually share what Haywan's doing. I'm going to talk about your fund for a minute, but it's DHEF, and I want to get the term right. It's the Global Sustainable Equity Fund, Growth Fund. But because it's been through a couple names, but it's been around for, I want to say, 25 years. I think it was 1994, 1991.
I read the bio, 1991.
1991. It started, and I believe it was Acuity when it started, but this was the first sustainable opportunities growth fund that was available in Canada. And it has been around, and there are options that are available for now. It's just that so often people don't know how to find them. And that due to the nature of our financial system, it's not the advisors, the people at the bank, the advisors that so many Canadians deal with, so often are not operating out of your best interests. They're actually salespeople selling products off the shelf. And unless you happen to go to someone who's good, who knew their stuff, that had this amazing fund on the shelf, there's a good chance that they would never even put it in front of you. What's great now is that the market is democratizing. It's opening up. A lot of people are starting to take control of their investments, right? By managing money online, it opens up. You can choose exactly what fund you want to buy. And as well, I would say the advisor network is starting to understand that, I'm just curious in the room, how many people ever went to an advisor and asked about these topics or had a question and had someone shoot them down a little bit or negative expressions, feelings that
About
tends
15% of the audience.
Yeah.
Most people, about 15% of hands.
I would say at least 15%. So that really it's a very common experience that people want these products, but because of the sales channel and what's available, they just haven't had access to them. So to me, it's really exciting that there are new products coming out all the time, and there are lots of opportunities. It's just that, people have to, again, to your point, ask questions and sometimes ask those tough questions and push back a little bit. So having this type of educational resource available to people, I think, is so useful to help you understand that you do have options. You don't need to sacrifice financial returns, but it is going to be a little bit tricky to be able to get those options to actually invest, because the default system that we have here is not really set up to let you buy them.
And so I think I saw a stat either say yesterday, there's something like 300 sustainable mutual funds or ETFs. Now there are a lot of products, but I guess you need to look under the hood And I guess my question to you, Haywan, is like, what actually goes under the hood, and how do you go about evaluating and choosing? And I know it's probably like a 20-page white paper that like they don't have the time for the whole thing, but if I'm looking at this fund, like what's in there?
I think you should look at what kind of companies this funds or strategy they are investing. So if you just see, just traditional banks name or energy companies, and it's quite difficult to understand, how they come about this investment decision making. So typically, I see always the literature the company provides, the fund provides. If you look at the description, first of all, and you understand what are the objectives, if the investment policy objectives actually addressing some of these issues that we talked about today, and that already it's a good start. And then you have to do your own research to look at some of the companies that these funds are investing that are actually aligning with, the values that you are sticking to. So I think that is just good start. But also there are now so many intermediaries, so many platforms that can help you. So there's an open database, open source database like Open Impact, Impact Base, and it lists all those funds or investment opportunities that you can have to, available to retail investors.
And now that we're moving fastly through from the why to the what to the how, like practical opportunities for the average investor. So I know Tom, probably a lot of investors don't have the ability to invest in your fund. But I guess like what are the products and type of asset classes and ways that individuals can literally go home and start investing? Kind of what first comes to mind.
Well, CoPower. Well, no, so I'll give you a landscape, right?
Yeah.
So we do have retail investors, but they're sophisticated investors. Our minimum investment level is $1 million. It's a $150 million fund. It's high risk, high reward. There's an individual I'm looking at right now who's an investor in my fund, and he's an investor in my first fund. And so we do have individuals, but they're sophisticated. They have to be. That's the way the law works. But the thing about clean tech is it moves from venture, which is basically you're putting money into a company that's inventing technology and bringing the technology to market and disrupting sort of the status quo. It moves across all the way to project finance. So for example, when CoPower is investing in a geothermal system or an LED lighting retrofit, that technology came from venture. So one of the things that we think about is we look for institutional partners who can move from venture to private equity, which is essentially larger checks, to project finance. So you're deploying technology, a solar farm, not a solar panel. Clean tech is unique as a kind of technology that it moves through those asset classes. So as stuff that we invest in percolates through the system, we change the economics of the kinds of projects that CoPower invests in. We make them more competitive, lower the cost of geothermal heat pumps, lower the cost of LED lighting through technology. Lower the cost of solar panels, so solar farms become more competitive. There's more of them, and then there's public assets that can move capital there, and they become. So that's sort of the spectrum of investment opportunities. I think on the retail side, my colleagues know better than I about what those opportunities are. But I want to make that point. And as Tim alluded to earlier, the internet is not a sector anymore, right? The internet was thought of as kind of, a couple nerds with some laptops and a router. That's not the internet today. You can't be a forestry company, agricultural company, chemistry company, movie theater without some sort of data play, right? Whether it's communications or supply chain control, whatever. In the same way, clean tech will underwrite everything in the economy 10 or 15 years from now. And so the kinds of investment opportunities that open up are across the spectrum. And those companies that are taking advantage of clean tech to become more competitive in a carbon constrained world are the kinds of companies that are going to succeed. And I think that's where your filters sort of kick in. So it's important to note that clean tech is not a sector. It underpins the economy, and understanding that those transformations are fundamental. And then investment professionals who are at the head of the line, who are thinking about things like climate risk and carbon risk, are leveraging alpha, right? They're generating alpha because they will be more competitive than their peers in years to come as that energy landscape changes. So that's kind of like the macro view. As far as retail investors, I think my colleagues know better than I.
Yeah, and I think actually even before Tim, like from that venture side waiver there, I think an interesting spot working backwards is like this impact space and like private alternatives. And I love, Jen, this is your world, like give us the like moving it more retail. What is that space of impact investing and what are the range of options for retail investors?
For retail investors who are looking at a scale of different impacts, so you can look at ESG funds, sustainable funds, and to Haywan's point, look under the hood and make sure that that matches your investment objectives. But as you move along the impact spectrum, you can move out of markets and go into private markets. So traditionally, infrastructure funds that invest in you can have clean energy projects, renewable energy projects, weren't available to individual investors. And so at CoPower, we're focused on, we invest in projects and we pool those projects together so that investors can have a bite-sized piece. So our minimum investment is $5,000. And so for an investor, you don't want to put your whole portfolio into something, but just like you don't want to have one stock or you don't want to have, one ETF, one TSX, for investors that are looking at a myriad ways to help. So through sustainable funds, if they can access venture capital funds, but look at all of your options and private placements, impact investments. And if you are interested in other impact investments, encourage you to go to the SVX, so the Social Venture Exchange, svx.ca. And there's other impact investments that you put in your investment objectives and you put in your risk and return appetite, and it will provide you with a list of other products. And so impact or private placements are a growing number of areas that are becoming more accessible to individual retail investors.
Awesome. That's great. And then Tim, do you want to keep bringing it towards?
Yeah, I mean, so the way, the framework that I use is very simple. Your portfolio is like a pie chart, right? And you're going to have both stocks and bonds. Very simple. Stocks are the riskier, right? High risk, high return, sort of the rabbit in the race. Bonds are more the turtle in the race. That's loans and debt, a little more safe and stable. The framework that I use is we split them up. And with your stocks, we do a big chunk of your portfolio for what I call doing less evil. Right, so this is where we get rid of all the evil companies, but you still want to own a lot of the big, traditional, what we would call blue chip companies, but get rid of the stuff that you specifically don't want to invest in. So whether that's tobacco and military, fossil fuels, pipelines, everyone is going to have a different definition of sort of what companies are evil. And this would be the area where you would have language like socially responsible investing. You mentioned ESG, environmental, social governance analysis, where you're trying to sort of get rid of the worst of the worst. And then we would carve out part of your portfolio for what I would call doing more good with your stocks. And this is where the AGF fund, I would say, really fits in well. Now, when it comes to those types of investments, they are, to Tom's point, a little higher risk. Generally, you get smaller companies that are a little more growth oriented, not always, but tends to be a little higher risk, high return. So I wouldn't suggest putting all of your money into those things, but it absolutely is a way to invest in really good companies that are going to benefit from this transition. On the bond side, it's the same thing. Most of your bonds are going to be what I call doing less evil. Get rid of the nasty stuff that you don't want in there. And then you can carve out part of your portfolio for what I would call impact bonds. So CoPower is a great example of this. There are also a number of community bonds that have been available. For them, the window opens and then they sell it, the window closes. So this would be things like CSI, the Center for Social Innovation. I don't know if anyone owns a CSI bond, or SolarShare, or there are a number of different organizations. Sadly, those aren't available right now. So what I love about CoPower is, hopefully now and forever, they will always be CoPower bonds available. And so that way, what you can do is end up with a really nice, well-rounded portfolio. It can be tailored to your specific financial goals, your risk return profile. If you want to do more of the doing more good stuff, that's fine. But just understand, that it should be part of an overall investment plan.
I think every dollar you invest, you're making impact. So you just want to make that positive impact. And you can do that. You can do 100% impact with your money. And there are now so much more options than before, because in the past, the perception of investing more responsibly, investing in clean tech, there was this negative perception about you're going to lose your money. But now there are there's academic studies that prove you don't need to sacrifice your return. So actually, you have so many options. In Canada, we have so many options in also retail space, not just equity, also fixed income. And on top of it, obviously, you can also think about what are the key, the topics or the issues that you care the most. And especially, we are talking about climate. So there are so many things that you can invest in. So almost if you look at, again, back to some of the funds that are offering, it's providing solutions to the water issues, climate issues, and waste, then that's it. And then you look at the return profile, and if it is reasonable, that is your option. So there are so many options that you can choose from. So it's again just about go out and ask and search.
Great. I've got more questions, but I've just seen a ton of questions coming up from online and from you guys. If you guys are texting them in, I'm going to get to these now. And if we have some more time, we'll go back to mine. But some really good questions have come up. First one, as a naive and lazy millennial, I want to follow your recommendations as easily as it is to use Wealthsimple. What do you recommend? Who's got a thought? Tim.
Wealthsimple's a robo-advisor. They use these things called ETFs, exchange traded funds. The problem is that it's a cookie cutter portfolio. So when you go with one of these robo-advisors, it's like take it or leave it. They do have a socially responsible portfolio, which is great. But when you open it up and look under the hood, right, one of my most popular blog posts is how sustainable is Wealthsimple's portfolio? Spoiler alert, not very. So really it's, but what you can do is the easiest thing right now is to open up, in my opinion, an online brokerage account. You can set your own little pie chart with your own ETFs. And there is now a tool, I'm just starting to play with it a little bit, called Passive, Passiv. But this essentially allows you to build your own robo portfolio. So it depends how lazy they are. If they really just want to set it and forget it, then I would say a mutual fund option, really, really good. Full service, if they've got enough money, finding a full service advisor that focuses on sustainable investing can be a really good option. But for the cheapest and seemingly the closest to a robo advisor, it would be an online broker, pick your own ETFs, and then use a third-party app like Passive to do that rebalancing for you.
And if I'm looking for someone to help, an advisor or whatnot, hey, you're part of the RIA. What is the RIA? How does that help? How does that fit?
My company is a member of RIA, so there are a lot of now advisors.
What does RIA stand for, first off?
It's a Responsible Investment Advisors.
Great.
So it's investment advisors, but they are a lot more specialized to help you and to align your investment, to be aligned with your values. So there are a lot of advisors out there. And then I think the website of RIA is ria.ca. If you look up, then there will be also a list of all those advisors on the website. So you can find your neighborhood, and then you can also find the right advisors.
Just going to also, because Tim's been so great with other things, but plug Tim. So Tim is one of a growing number of independent financial planners that has created this business from the last 10 years. And now seeing that hockey puck, I don't know if you remember, but Greg called him a media mogul. So that's Tim. But Tim's a growing number of independent financial planners. So if you don't want to go through an advisor, if you don't want to do that fees, and you're still comfortable purchasing your own investments, someone like Tim can also help you with that.
Yeah, and now let's talk a little bit about returns. The next question is, how does return on an environmentally sustainable portfolio compare with market returns? Thoughts, studies,
Yes.
What's the world saying? Yeah.
Yeah, there are so many studies out there. And again, my investment objective is always you have to beat the market return and at the same time you want to make this positive impact. And that's the two things, that we are trying to achieve. And again, there are so many studies, and I can point out later if you want more resources. And there are 1,000, I think, academic studies out there to show that this can work. But maybe it doesn't necessarily mean that you will have massive, outperformance. But at the same time, so many companies who are addressing these issues, their cost of capital is a lot lower. That gives them more competitive advantage. And also, a lot of studies will show that either it's plus or it's a similar return.
And it's not worded the same, but from that question, but what he wants so ESG funds or environmental, social, and governance factors, when you apply that to a basic portfolio, you're essentially choosing the companies from the industry that have the highest environmental and social and governance factors. And so if you create a portfolio of the highest rated ESG companies, what Haywan just mentioned, there are thousands of studies that shown that an ESG strong portfolio actually has a higher return and reduces risk. And a lot of that is looking at what are those tail risks that bad ESG get. So examples of that are VW, bad social, bad environmental. They were doing that. That's a huge risk. So when that gets found out, you can lose a lot of money. And so ESG is can essentially help protect from the downside, but studies have shown that empirically going back 20 years, it can create a stronger portfolio.
Yeah, Tim.
Yeah, and so the best data that I've got model portfolios on my blog, sustainableeconomist.com. And so what's nice about the model portfolios, A, it gives people tangible examples, so you can see what's what, but B, it lets me track the performance over time. So I compare my portfolios to what I call the Canadian couch potato portfolio, which is like a really famous, it's like the #1 personal finance blog. The guy's kind of my hero, but he has this couch potato approach that a lot of the robo-advisors kind of mimic. And so my portfolios have done just as well as those couch potato portfolios. The outperformance has been over 3 years, 5 years, 10 years, has been like a little bit. My portfolios have done a little bit better. The only one that's been down over the past year comparatively is the fossil fuel free portfolio, because obviously that got rid of a lot of the oil and gas stuff, which actually had a slight little rebound. So when I did the numbers, that had just been a little bit less in the past year. So it's one of these things where it's like year to year, month to month, I can't promise you that returns are going to be good. Realistically, it's the type of thing where if the market goes up, everything's going to do well. If the market falls, everything is going to fall. But really what we find is that by finding the sort of best in sector, by looking at this extra level of risk, you do tend to do better financially. The best example I can give is something called the Jantzi Social Index, which is kind of the benchmark for responsible investing in Canada. And that has outperformed the TSX 60, which is the standard benchmark, the 60 largest companies on the Toronto Stock Exchange. And the reason for that is a very simple reason. How many people have heard recently about SNC-Lavalin, right? Does anyone know how their stock has done? Not very well. Shocking. That's a company that had been embroiled in a lot of controversies in the past, and they got nailed again. I'm so surprised. Forgive my sarcasm, but that really the Jantzi Social Index knew it had done this ESG screen. It had omitted that company. It does not own that company inside the fund, whereas the TSX 60, they don't look at those risk factors at all. And so SNC-Lavalin was a part of that. So that would be one illustrative example for why socially responsible or these types of sort of ESG investments do just as well, if not better. And then the flip side is that if we have the world that Tom is really trying to build here, that really in that scenario where we see that inflection point, that now we're in a situation where really the outperformance of the solutions, it's there today. But we're talking about, the potential, he talked about this term alpha, which means outperformance. In that scenario where we take climate change seriously, and like the political pendulum sort of swings back, and if I can dream about a Green New Deal or something amazing like that, that now all of a sudden we're in a scenario where these portfolios are just going to absolutely shoot the lights out compared to a traditional investment portfolio.
Great. I've got some questions here from investors who want to invest in the clean energy and clean tech space, but are concerned about the risk. So one person said, it seems that even though solar PV technology has been expanding rapidly, individual companies in the field are often swamped by the pace of change and sometimes go out of business. How can you assess risk and invest more reliably in these fields? Any thoughts?
Probably a good question for him.
Yeah. So that's what venture capitalists do. So we don't invest in publicly traded companies. Those are different sets of metrics. Those are mature companies. But the reason we're paid as fund managers is because we actively choose technologies that could compete against incumbents, We sit on the boards. We're directly involved in the strategic direction of those companies. And we have particular views of risk. So for example, we understand that as technology companies undergo a transition from inventing and producing a new kind of energy storage project, for example, you have to cross the chasm over to project finance. And that's so we look at technology risk and say, well, what kinds of technologies are better able to do that? So Arcturn, for example, has a view called systemic innovation. We like to invest in companies where they are taking known materials, known machinery, known engineering techniques, and so on, known manufacturing production methods, putting them together in a new way to get a new result, because that minimizes the risk as that company looks to expand from building a technology to deploying that technology, where you need bankers, project debt, project finance to back your technology. So that's an example of what we do as a venture fund manager, but that's very different. It's very hands-on, it's very entrepreneurial. You're building a company, you're picking a company. That's very different from looking at a field of entrants who are fairly mature, finding the PV manufacturers who are going to survive against the Chinese behemoth of manufacturing. That's a different kind of question.
Yeah, I can talk about this because, again, this is what I do every day, to do due diligence on every single company, and that we are constantly reviewing these companies in the different sectors. So PV sector, again, there are so many companies that are making modules, solar PV modules that are now a lot more commoditized. So that's why this is a difficult investment to do. Just you cannot just go, let's just buy solar ETF.
Anything with solar in it, right?
Yes.
Like just search solar, I'm going to buy it all.
Yes,
right?
and you have to do the proper due diligence. You have to know what kind of competitive advantage the company has. So that's why we are spending our time and to talk to the management to understand what are the competitive edge or the moat this company has. So not just having the solar name or solar product will help your investment. You need to know what and where in the value chain this company is positioned, and again, what are the what kind of competitive advantages the company can provide. So again, we are not heavily investing in this public equity in a solar because of this commoditized division, that when the companies get bigger, you go after the larger market, but actually it's all about just low cost. So low cost manufacturing itself isn't just most attractive investment.
Just a quick PS, I forgot the question was about PV in particular. So my response to that is to say, pick technologies that don't compete with those manufacturers, pick technologies that can license into those manufacturers to help them better compete with each other. We have a company called Morgan Solar that is doing just that. Rather than, they have a new kind of solar panel. Rather than manufacturing panels, they're going through the difficult process of figuring out how to, wrestle with the dragon and license IP into China and use that to have the large manufacturing giants compete against each other. So that's a strategy that we would use in that particular market.
Good example. As environmentally conscious investors, do you also consider the social implications of the switch to green energy? If so, how is this reflected in your investment decisions? So high technology can lead to layoffs at the utilities you've mentioned, for example. How can more honest earners get a piece of that pie? They too, after all, stand to lose probably more in the event of catastrophic climate change.
I would first point out that any economic transition that is going to deploy clean energy at scale requires every trade in vast numbers. If we come close to sort of stopping at 2 or 3 degrees, the number of plumbers, electricians, pipe fitters, architects, window glazers that we will need to retrofit housing stock and deploy new energy solar panels for the next 20 years will swamp any kind of deployment that we currently see in the fossil fuel sector, which is already highly automated. The amount of kilowatt hours you get from per man hour in coal or heavy oil is huge. It's automated. So the first thing to note is that this economic transition happens to involve an enormous amount of manpower. And I think that's the short-term answer to that. The longer-term answer to that is to say that any technological transition has winners and losers, right from automatic weaving machines to cars. Self-driving cars will be a huge driver of unemployment in the United States. Truckers, for example, that's tragic. So I think you need to take that into account with policy and so on. But the point is, at the end of that transition, it's always the case that we are, as a whole, better off. So the trick, unfortunately, for the trades is pick a trade that will play into the clean energy, the Green New Deal, the retrofitting of our houses, the rebuilding of energy systems. That'll get you through the next 20 or 30 years. Beyond that, I think automation is a huge issue. And I don't know there's any quick answer to that. But in terms of the scale, you can't outsource to China the retrofit of a building, right? The vast majority of the value of that retrofit is in the man hours it takes to retrofit that building, for example. So there's absolutely nothing to fear in the clean energy revolution. There is everything to gain as an average laborer.
Let's jump to a whole different topic. What if the federal Conservative Party wins the next election? And what do you think the impact's going to be on green or impact investing? Thoughts?
I mean, I can just give you an example. You know, we went through a different election cycle, and not just in Canada, and globally, and green investment hasn't been reduced at all. You know, whatever election cycle that we went through, it's just has been growing exponentially. So it can be, maybe there can be some temporary regulatory stop, but you cannot be stopped. We saw it even in the States right now. In the US, the actual clean investment hasn't been actually reduced at all. You know, and now there's maybe federally, you know, you will try to pressure, but now then all of a sudden states come out with different policy, better policy, and even all the cities now get together, and cities are adopting, you know, the policies to go towards a transition rather than back out from the transition, because it's already happening.
Yeah, and the momentum that was so strong, because in 2016, Trump pulled out of the Paris Agreement, but to Haywan's point, you had over 50 municipalities and individual parties coming together and to do it. And the other point of the argument is just the economics. So even in Ontario, where we saw a new government come in at the end of the summer, there are so many clean energy projects in CoPower's pipeline of projects that we would like to finance that don't have subsidies, that are just strong on the economics on their own. So energy efficiency projects, for example, LED is a great example of that, where they stand alone. So they don't rely on subsidies like clean energy did, 15 years ago.
Can I take a contrarian position? I think all of that is roughly true, but policy matters. I don't know why GM left Ontario. You'd have to ask GM. But I do know that they have committed heavily to electric vehicle development. And I know that the $3 billion that the Ontario Cap and Trade program raised, a lot of that was aimed at GM to help them with their electric vehicle program. So all else being equal, I think the disappearance of that policy had a very chilling effect on GM. It had a very chilling effect on the willingness of large industrial polluters to do more than just standard energy retrofits. They were willing to try new innovation, to find deeper ways to cut their emissions, and they were legitimately and willingly at the table with that $3 billion ready to be deployed, mainly targeting Ontario-based solutions first. So I think that had a chilling effect on the long-term signals being sent to industry, and that it won't change things tomorrow, but it will change things 5 years from now. It will change things 10 years from now, because the accelerative boost that would have given our companies in the global markets was significant, and we will lose that market share now to Germany, South Korea, and other countries that are being very targeted in their policy. So it's not about whether or not clean energy, the stuff that's viable today, remains viable. Of course it remains viable. Solar is $300 billion a year. The question is, what is the next phase of clean tech deployment, and is that going to be viable, and who's going to own that piece of the pie? Ontario blinked, we lost when we blinked, and if Canada blinks in the next election and we take away the structural supports the federal government is putting in through EDC, BDC, SDPC, and so on, that will hurt us 10 years from now in our market share of the single largest market of the 21st century, which is clean tech. So I agree that there is a lot of stuff that will continue. You can't stop what's economically inevitable, which is what works today. The question is, will we own what works tomorrow? And that is a policy-driven solution as much as anything else.
For Tim, move your money and vote.
And vote.
Move your money.
And canvas, like knock on doors and get involved and consider running. We need good candidates.
And for progressives who are thinking of leaving the Liberals, you will elect Scheer.
So I think politics, and I don't want to get too deep into the specific parties, but to say that I think that policy does matter. I think that what it comes down to is the pace of change. So how quickly versus how slow. And to Tom's point, where are those jobs going to be, and what jurisdictions are going to capture market share in terms of this new economy that's being built. Really, the question that I have that I think is more pertinent, I don't see a huge difference in terms of our, the liberal conservative. I know there are differences. Yes, I do see. I don't see it as being a major swing. What I think is a bigger swing is what's going to happen in the U.S. in 2 years. That we'll see. But my question is, what happens if the political pendulum swings in the U.S. and we do get a Democratic president that embraces a Green New Deal and understands that climate change is the existential threat that it is. In that scenario, where's Canada? That we now have the opportunity to get ahead of that transition. We know it's inevitable. And we have this 2-year window, hopefully not a 6-year window, a 2-year window
to gain advantage
and to build and to get that competitive advantage and to encourage companies to come here. Because my big fear is that, we continue to sort of double down on Canada as an extractive country on oil and gas, on mining, and that we continue to go down that path. And as soon as the U.S., and I don't want to put all my stock in the Democratic Party sort of having their stuff together, and but if they do pull it off, that now we're in a situation where Canada could be left behind yet again. We've seen this story play out.
And we're ahead of the curve now.
I
would know. We have a far higher share of the global top 100 clean tech companies than our population would suggest.
Yeah.
So we are ahead of the game. There's been 10 or 12 years of hard work and capital put into play by folks like STTC and so on that has seeded an industry in Canada that is beginning to flex its muscles globally. It takes a long time to build a clean tech company. It takes 10 years. And we're beginning to see those results. And I would point out that the global clean tech market is predicted to be $2 trillion by 2030. If we get only our pro rata share of that market, our clean tech sector will be bigger than our automotive sector. That's the size of the pie that's in play. So when we think about long-term strategic goals for this country, I'm an economic patriot. I think we should, go to where the puck's going to be, as Gretzky said. And it's a question of time, not if. As Tim said, it's inevitable that clean tech will win the day. The question is, will Canada have less than, equal to, or greater than our pro rata share of that market? And that's an economic argument. That's not an environmental argument. That's an argument that the left, right, and center can all agree on. It would be better for Canada to have more than its pro rata share than less.
In fact, clean tech, talking about clean tech sector and auto sector, now all the sectors are even converging. Auto becoming clean tech, because the only way to survive in auto sector is now thinking about the new models that don't rely on combustion engine. So how to make cleaner cars or the safer cars, that's the only growth driver for the auto sector. So all of a sudden, this clean tech kind of converging with every other sector, healthcare becoming more tech and cleaner and safer, and also industrial tech or the auto tech. And then I'm seeing this conversion from all different sectors right now. So no matter what kind of the policy there are, obviously policy matters. That's why we are also engaging with the policymakers. But again, this is something that I don't see that's going to be kind of the going backward.
We have a couple questions here talking about pressure on regulators and institutions. And so first, what can be done to pressure the Canadian Pension Plan Investment Board to invest more sustainably and exit from fossil fuels?
Yeah, sure. Really, it's this is where it is sort of a bit a grassroots effort. So there are a couple organizations. Sadly, I don't have one specific organization I can share that is kind of working on this file. But really what this comes down to is pressure on federal MPs. It was really interesting. CPP kind of got into hot water because it came out that they had been making investments in private prisons in the US. So these are like for-profit prisons that were making money from the Trump's detaining kids policy. Yeah. So, and Bill Morneau sort of stuck his foot in his mouth in question period. So it became a story that led me to really push and look at CPP's sustainable investment policy. They are doing some good work. I got to say, I was impressed. It's not like they're doing nothing, but really what we need to do is have them keep moving in the right direction. The initiative, and again, I wish it was more actionable. I wish it was like, here's an organization you could support and you could do it. But there is a global organization called PRI, Principles for Responsible Investment. For the longest time, it's been a voluntary thing. So organizations could just sign up and say, yes, we believe in responsible investment. And I just saw that for the first time. I believe it's going to be in 2021 in order to retain membership. In this organization, they're going to have to start measuring carbon risk, climate risk throughout the portfolio. Now, they don't necessarily have to disclose that, right? So they don't have to like put it on their website and tell everyone what their exposure is, but organizations are going to have to start, these pension plans are going to have to start doing it. So really what it comes down to is, find the little leverage points. If it's CPP, I hate it, but really your avenue is going to be your federal MP. Really what I would love to see would be a motion just to get some of these issues and to get best practices as part of that investment policy.
And now, to what extent are the Canadian banks and TSX exposed to the oil sands, coal and other fossil fuel companies and assets, and how will they be affected by carbon pricing? Question.
Well, they all disclose it. So all of the big banks, in terms of their commercial lending portfolio, every bank will have exposure to oil and gas companies. Some have more and some have less, but all of them do. And again, if it's 20% of the TSX, it's roughly between 20 and 25% of the Canadian economy. And so for a financial institution to not lend to that, that would, for them, that they would lose that piece. But definitely all of them disclose it. And so if you are interested, you can go to CEDAR and take a look at their annual report.
But there are a lot of banks globally now, they come up with most they don't want to encourage the new project in fossil fuel. So they come up with some of this policy that they are not going to lend new capital, new lending towards this fossil fuel or kind of the ground project. They will encourage more green project. That's exactly what we need also from our own financial institutions.
But it's not carbon pricing that is exposing that risk. Carbon pricing can be absorbed by the oil patch as the cost of doing business. If we got the kind of carbon pricing we need in the hundreds of dollars, yes, absolutely. But the kind of nibbling around the edges carbon pricing that is politically palatable, $10 to $30 to $40 a ton, is not going to make the difference to heavy oil sands. What is making the difference is plain old economics. Those projects are uneconomic. They cannot compete against shale oil in the United States. And as I mentioned earlier, it's the first oil spigot that will get turned off when demand for oil begins to flatten and go the other way, which we can already see the signs of. So it's pure economics that is going to put Alberta out of business, not a price on carbon. And I think people like to blame it on a price on carbon, but that is not what is to blame. It is pure economics. And that's why I think long-term investment decisions like the Canadian government buying the Trans Mountain Pipeline is absolutely ludicrous.
So to follow up, perfect timing, another question came in. Without a price on carbon that is not ridiculously low like it is now, how can clean tech investments be profitable? I mean, not my words, I mean, it seems that without a price on carbon, there is no market for most of these technologies, in bracket, not all, of course.
No, nonsense. Solar power is 3 cents a kilowatt hour in many jurisdictions around the world. It is less cost for new solar than the operating cost of a natural gas plant in 49 jurisdictions around the world today. So it is not about whether clean tech can compete, it's about how it gains scale. The next phase of scale is energy storage. That's why I talk about HydroStore. If you can store power cheaply, you will not run up against the 5 to 10% limit that most utilities put on solar on their grids. That's why it's important that we see projects, Canadian projects in Australia, bidding against natural gas and coal on the Australian grid and beating them at their own game without subsidies. So it is a myth that clean tech needs subsidies to compete. Every industry, I would note, as it scales, requires strategic government support, though. The auto sector did, the aerospace sector did, healthcare does, the nuclear, every single sector of any size has had strategic government support, sometimes in the form of EDC, providing wraps around projects, debt guarantees to other jurisdictions to take a political risk. There is always strategic support for industries as they grow. Clean tech is no different. That is not the same as saying, though, that clean tech can't compete in the open market against fossil fuels. It does, it is, and it will. We only invest in companies that can compete in the open market against fossil fuels.
Tim.
So there.
Yeah, I mean,
Tim.
what I would say is that it's really, in my mind, the technology exists. It's not a technological challenge. It's not a policy or government challenge. It's not, to me, the biggest challenge is it's a financing challenge. That a lot of these green technologies for the deployment require upfront capital financing. So we can talk about retrofits and switching to LED or geothermal or solar farm, but all the money is required upfront, right? And then with the payback over time. And it's a really nice payback, but it's over time. It requires a long-term horizon. So I think that with a lot of these arguments and, I can't compete and things like that, is that, yeah, it's the trick is that really what we need is the upfront capital, which is why debt products like green bonds are so good, which is why we're starting to see a lot of banks moving in this direction. And quite frankly, again, to be, what did you call it, a nationalist, a national
Economic
economist,
nationalist.
economic nationalist. So one thing that Canada figured out
Economic
really well,
patriot.
economic
Nationalist is a bad
patriot,
word.
yes, patriot. But one thing that we figured out here in Canada was how to fund mining companies. That mining, it was a very similar challenge, where it was all this money up front, everything up front, for a really, really long-term payback, right? And it was really hard to get a lot of these mines funded originally. And that's where Toronto and Bay Street really kind of cut its teeth. For a long time, we were, and to some degree still are, global leaders when it comes to investments in mining. Now, obviously, a lot of environmental issues, a lot of social issues within that sector. But the financing model, like, we solved that challenge here in Canada. So to me, it's like we are so well suited from a financial perspective to solve this challenge, to provide that financing up front. Let's, retrofit all of our buildings. Let's build all this upfront infrastructure, right, to be able to earn returns so that we can get interest from our bonds. So I think we're in a really good position. I think that unfortunately it's a bit of a generational thing where a lot of people on Bay Street are really kind of stuck in their ways, right? And they're so used to funding mining projects that this stuff seems scary and it seems risky. And there's this myth that you're not going to make any money doing it and it's dependent on subsidies. And all of that is frankly BS. Right? It's just that really, I think, to your point, what a price on carbon does is it provides a signal where it's just a really clear psychological signal that this is the direction that we're moving. And I think, if anything, it's more of a psychological policy than it is an economic one.
So
And that's
talking-
really, just
Go
to
for it.
finish it, because that's the opportunity for you. The longer that Bay Street takes, the more returns and the more.
But we need their
opportunities
help. Don't forget, clean tech needs scale. We need risk finance to get the next generation of technology into the market at scale. And that's where I think Bay Street is largely letting the sector down. And that's why I think there is still room for Ottawa and policy to play a strategic role. So for example, that mining financing stuff, it wasn't just financing mines. We figured out a mechanism that was tax efficient that allowed investors to take risk on mine exploration. It was the TSXV venture that did mining exploration, which was highly risky stuff. And we made it tax advantageous for investors to participate there. So again, structural supports to accelerate this stuff in the market is still required.
And at least directionally, it's going that way because there are now more and more pressure on financial institutions right now. So TCFD, the Task Force on Climate-Related Disclosure, so it's supported by FSB, that's Financial Stability Board, and again, Mark Carney is leading this. And we are seeing there are a lot of pressures, and now the financial institution, we have to disclose how we are looking at the climate risk and how we are, what kind of the governance structure we have to address climate risk, and again, how we are investing. And there will be more and more scrutiny and looking at our investment. And then if that is against kind of all this the statement the finance institutions have, we are going to incorporate climate risk or opportunity into our investment decision making. So you have to, again, one of those who have to ask and ask and ask. And because if we don't ask government and then government doesn't pressure, then again you have to almost have create the ecosystem to encourage more of this investment.
Is disclosure making a difference? I guess is the question, right? Are investors actually making different decisions based on disclosure?
I mean, again, I don't think disclosure is the solution, and disclosure is just starting point. If you have to disclose.
Also, what does disclosure mean when we talk about that?
Yeah, so disclosure is basically we, put our, into the reporting, basically saying to the public domain, we are saying, how much of this climate investment that we are making, we consider climate factors in our investment. So all those things that we are reporting, we are communicating into the public in the public domain. And when you have to report, when you have to disclose either to the to the government or to the public, you all of a sudden, and every company now, we are as an investors, I am asking companies, can you disclose your climate footprint and or your carbon emissions? Then companies, companies are not pressured, companies can get away with it, they will not do anything. So we typically say, whatever gets measured gets managed. So you have to actually ask, you have to measure this. Then company starts measuring and starts managing. Same thing with the investors. We have to measure and manage.
Let's go back to the scale question about the idea of financing moving technologies. Let's talk about EVs. So the question is, when do you expect EVs to impact the price of oil? And can you speak to the build out of an EV charging network and the recent announcement by Petro-Canada to develop their free-to-use network? EVs, oil, thoughts?
I think what will affect the price of oil faster is electric buses, actually. The number of electric buses in China is mind-numbing because those have faster paybacks. Those are fleets that can be well controlled, and you have the ability of municipal governments to immediately create large-scale demand. So if we include buses in EVs, not just imagining sort of Teslas and Bolts, I would argue it's probably already beginning to do it. I can't remember the numbers, maybe Tim, off the top of your head, but someone had barrels of oil equivalent of the Chinese bus fleet, and it's in the hundreds of thousands of barrels a day already. And again, you can't see the curve's exponential yet because it's early days. So I would argue that if you're a forward-thinking investor and you're looking to invest in reserves of companies, that's the future price of oil, right? The reserves that are in the ground. And people deciding not to lend or build new fossil fuel infrastructure, I think it's a result of people beginning to understand that transition is already underway. While you don't see it at the pump, you see it on money being spent on exploration, development, and new fossil fuel infrastructure.
We've got a couple minutes, so I want to get these last ones through. This is much more tactical. If I had $50,000 to invest for 2 to 3 years before making a down payment on a house, which sectors would you invest in?
Don't. 2 to 3 years, don't. High interest savings account. You should not. But it's a 6-year
minimum 4 years. Minimum 4 years.
And we are private placements, and so yes, for
a down payment.
Yeah.
No
You
risk.
had a bond that was
No
in and out,
risk.
didn't you? It was open door. No. Okay.
No. It's honestly when
2
it
to
comes
3 years. What do I do with my money?
a high interest savings account. Honestly, it's boring,
Yeah.
but it's safe. I mean, really, you might crash. Like I've literally met people that found their dream home that are like, it's perfect. I love it. It's amazing. And the stock market just crashed. And now my investments are worth 40%. It's a very low probability, but and we can't control it. And it doesn't matter what sectors you're invested in. When the stock market crashes, it crashes.
You need a longer time frame.
If you have a longer term horizon, 5 years to 10 years, I have lots of amazing options for you. But 2 to 3 years, do not invest your money. Either GICs that are going to come due, or right now the best bet is a high interest savings account.
Right. And as an investor,
I have feelings.
as an investor, how can I learn about the carbon footprint and climate risk of potential investments?
Yeah,
Yeah.
absolutely. And part of that is for the disclosure argument. And so if you do have an advisor and they give you your portfolio of mutual funds and ETFs, push them so that they can report on that internally. So asset managers can subscribe to third-party services to start to measure it. It's not cheap, but they can do it. And so push your advisor. Or if you're invested in a specific company, the company should be starting. A lot of companies are starting to report on it, so it should be made public. And if it's not, you can push them to do it. And so, if you are invested in the TSX, so the S&P TSX, if you just go to their webpage, they will give you a carbon intensity number. So per dollar amount invested, here's what your footprint looks like.
Yeah, there is a resource, and I forget the URL off the top of my head, but I've got it bookmarked at home. I think it's like fossilfreefunds.org, something like that. Is that it? There's now, it's pretty cool. They don't have everything, every single fund on there, so I'd be kind of curious to see if your fund is on there. But they do have a lot of different funds. You type it in, it searches, it comes up, and it'll show you the carbon footprint of that fund. Sometimes there are some shocking things, to your point. You know, I looked at a water ETF, and I was like, oh, it's water. And there was like one company that had this crazy high carbon footprint, Veolia. So it was just really, really interesting, but a fun tool to play with for sure.
Yeah, and just on that, it's interesting because when you do look at companies, and so, for example, looking at the S&P 500, some of the highest carbon intensity companies are not what you think. So Intercontinental Hotels is a really great example. Hotel company, thousands of hotels all over the world. But when you're paying hundreds of dollars to sleep overnight, you want your room really, really nice and cold. And so the emissions from all of those hotels are actually incredibly high, and they're one of the largest emitters. So take a look at that portfolio, because I think a lot of the individual companies that you don't naturally think of, like Canadian Grocers, it would surprise you.
And so we've got literally 2 minutes left, and I think everyone from this conversation, they're leaving. What are the practical steps? What do you want people to do, consider, think about? What are the next steps for people here to do to work towards an ethical or a clean or a green portfolio? Where do you go from here, Jen?
Yeah, I'll just keeping with the carbon footprint. For a lot of investors that aren't aware, take a look at your own portfolio right now. So if you have an RSP through your company, take a look at what the underlying stocks are and just ask yourself if that is representative of you as a person. And so if you are trying to take steps in your own life to reduce your footprint, take the next step and do it. And or if you're someone that very much values social impact or social good, take a look at those companies, take a look at their figures, or go to svx.ca and look at investments that represent you, so that as you continue to grow your retirement accounts for retirement, that portfolio has the same values and is potentially being put to good use.
And I think sometimes you get kind of you get scared about knowing what you're investing. And I think that is really a good starting point. You have to know what you're investing. So you have to basically understand what kind of companies, what kind of funds. If you have a pension fund and then someone else is managing the funds, so you probably think, okay, I have no idea. But you have to actually ask to understand, because that has a huge implication, huge impact on our society. So individual, I think, can make, again, the big change altogether. So just knowing, I think, is the most important thing.
Tom, what do you want to tell people? They're leaving this. What do you want them to do?
I think my 3 colleagues have done a pretty good job. Know what you're investing in, be aware of what it is you want to invest in, and ask your advisor what you're in and where you should go.
Tim?
I'm just going to say, for the people who ask their advisor and get stuck and run up against that wall where they just don't listen to you, remember, it's your money. This is you're the customer here. This is your money. This is your investment. And if the person is not willing to work with you on these issues, find someone who will. And I would also say, don't get stuck. That I think when we ask questions and we start talking about investments, it's really, really easy to get overwhelmed by the details and by everything. So don't get stuck. Make that first investment, even if it's not perfect, even if it's not right, but just take that first step to be able to do something. Big part of this is iterative, right? So you're going to do it. You're going to, you're going to learn as you go, right? Small steps in the right direction. And if you get stuck, straight up contact me. Like that's what I do is I unstick people when it comes to these issues.
Great. We are 8 o'clock right on the dot. I want to say first an apologies for the people that asked questions. I've got a whole list of them here that we couldn't get to. So thank you so much for the questions. Apologies for not getting to them. But thank you for being part of this conversation. And also thank you to our awesome community partners from Climate Reality to CBSR to Project Neutral, wonderful community organizations helping out. And a huge round of applause for all of our panelists. Thank you so much for being part of it. And as I started this event, you'll all be getting an email afterwards with not only the video, but also resources that were listed so that you guys can continue your path. So thank you so much and have a fantastic night.
That was fun.
Yes.
Bye, everybody.
Like,